Hi guys, welcome back to the channel. My name is Dave, and today we're talking about one of the big decisions when you sell a covered call, and that is what strike price should I pick? Should I do it out of the money, at the money, in the money? What is the best option for me? So today I'm going to try to answer that question for you. If that is what you're looking for, please stick around. Whoop. So we do talk a lot about income-oriented ETFs on this channel, but I'm still primarily a growth stock and ETF guy. I want that growth long term. I don't want the tax liability, so I invest in those types of products. But as I get older, I'm looking more and more towards diversification into different asset classes. So one, for example, easy low-hanging fruit is bonds. I've never been a big bond guy, but I'm building out my bond portfolio slowly over time, adding to those positions. One way to diversify. Another one that I'm sort of focused on here is market neutral strategies for those times in the market when the market's not really doing anything. And one thing that would fall into this category would be covered call strategies. So I've always sold lots of covered calls, as you probably know, and I talk lots about trading options and things like that. So today we're going to go into covered calls and picking the strike price, because depending on what you're trying to do will change how you might go about selling that covered call in the first place. Now, a market neutral strategy is just a strategy where you're trying to reduce market risk, typically by pairing up a short position with a long position, like a covered call. Now, covered call is kind of just acts as a little bit of a hedge, but depending on where you sell that call will determine how big of a hedge you're actually adding to your position. So it falls into this category, but it's not a full, complete hedge. So if we decide to go this route of selling the classic covered call, which strike price is best for us? Well, the ultimate goal of any sold call is to pick the exact price where it's going to be at expiration date. So if we pick out 45 days from now, what's the price of the stock or ETF going to be? In hindsight, that's always going to be the best choice for our sold covered call. However, this is rather difficult to do, as you can guess. Just as an example, let's go with Nvidia stock. Right, we have earnings coming up next week. Some people are bullish, some people are bearish. The range is going to be quite wide about where people think that's going to be after earnings come out. So we don't really know. And for that reason, with any stock or ETF that we own and we want to sell a covered call against it, we have to have a strategy behind it. Are we bullish? Are we neutral? Are we bearish? What do we think about this stock or ETF that we own? And that should determine what kind of strike price we're looking at selling. So a few things first, stock XYZ does not exist. Therefore, the numbers are just estimations. And if you ever want a full hedge, you would buy a put. Covered call will just give you a partial hedge. And this data here is assuming you hold the sold option till expiration, which more often than not, and for those that are new to options, we will often exit the option position well before expiration. Also, it is a covered call, so I imagine you already own 100 shares of imaginary XYZ stock. Now, this table is just a quick summary of what we will be covering. Selling an out-of-the-money call is typically when we still want some growth in the stock, but we want to hedge ourselves just a bit. Selling at the money is when we still like the stock, but feel it is fairly valued. Selling at the money maximizes the time value of the option. It provides the most extrinsic value, plus it offers a little hedge. Stock up, fine, you can have it. Stock down, I'll keep it, and the qualified dividend, for example. And selling in the money will provide the largest hedge, but will be the most difficult to manage. So with that said, let's jump in. So hopefully we can all agree that we just do not know where any stock or ETF is going to be 45 days from now. It's completely a situational decision based upon your view of a particular stock or ETF. So let's start with selling an out-of-the-money OTM call, right? So in this case, we're going to use stock XYZ as our example. It's trading at $100 a share. We're going to sell a 110 call. All right, simple enough. So in this case, because I'm selling out of the money, I must love the stock. I love the stock. I want to keep it, maintain control of those shares. I want to sell an out of the money call to add just a little bit of a hedge, but provide room for my stock to grow, right? This offers us the smallest hedge overall, and it is the least market neutral. And I hear this a lot from investors who like conservative dividend paying stocks, and they like to sell far out of the money covered calls to collect another 2 or 3% on top of that dividend. And that's their goal annually. If they get pinched every so often because the stock takes off, then they might lose a little bit on that option, but they're still gaining on the stock. And overall, this reduces the beta of their portfolio. It's just a conservative approach. They want to continue to own the stock, maintain control of it, and it's a nice little approach. So by doing this, when we sell this 110 call, what are we actually doing? So the first green area here is where we hope the stock stays, with the best case scenario being XYZ goes straight towards that 110 sold call price. Now this is where we have maximized stock appreciation, and we keep the $50 option premium, the perfect situation. Now the next area that goes up to 110.50 here, this is our break even if we just think about the option itself. This is the point where the option we sold for 50 bucks will now cost us $50 to close it. Basically no harm, no foul on the option portion. However, anywhere past the 110 point here, and we've capped ourselves by selling the call in the first place. So just for example, if the stock went to 113, we would have to pay about $300 to close the call that we sold for 50 bucks in the first place. So we would have an overall $250 loss on the option. But we have stock that is now worth $1,300 more because it went from 100 to 113. So on paper, we have an overall paper gain of $1,050. We can do the same thing and think about the stock going to 110. If the stock went to 110, since we'd have $1,000 from the stock going up, and we'd have $50 that we would keep from the call, we would still have $1,050. Now the actual hedge here comes in the form of providing us a break-even point or reduction in basis, however you like to think about it, if the stock declines by 50 cents or 50 bucks. Since we're going to keep the option premium when the option expires worthless. Now anything below 95.50 and we would have a greater unrealized loss on the stock share price versus the premium we collected. But hey, and in this situation we're still better off compared to having not sold an option in the first place. So now let's consider selling an at the money call. Same exact setup, stock XYZ out 45 days, and we sell the $100 call with XYZ sitting at $100. In this case, we're really trying to maximize time value, maximize theta decay. The goal here is to have the stock stay close to 100. So my mood is I don't really know, I don't really care that much. I'm trying to maximize what I can collect from this option. Now we split option values into two things. There's intrinsic actual built-in value and then the extrinsic value, which is the time value. So again, that's maximized when we're selling at the money. So in this case, let's say I collected $300 for selling this call option, and that's going to give me an upper limit and lower limit that we were going to establish just like we did in the last one of 103 down to 97. So if the stock goes to 103, right, I'm going to have to pay $300 to close the option because I'm offering to sell this call and they're giving me 300 bucks up front. So my break-even value here on my option is going to be at 103 because at expiration, if the stock goes to 103, I have to pay 300 bucks, which I already received. That's my break even. However, I would still have a $300 paper gain from the stock going from 100 to 103. It would simply be capped at this $300 gain anywhere above 100, and it would be up to me to manage either closing the option or allowing the shares to just be called away. So if the stock went to 120, I would have a huge loss on the option of $1,700, but I would have a $2,000 gain on the shares of stock. Should I close the option and realize the loss so I can keep my shares, or should I let the option expire, keep the $300 in option premium, and lose the stock at $100 per share? Now, if the stock goes down to 97, right, I'm going to be losing $300 in stock value, but I keep the $300 from the sold option. So this is my break even on the low side, or my 3% hedge that I put in place for this particular option when I sold this call. Now, when I sell an at-the-money call on a stock or ETF that I own, I still like the stock enough to keep it in my portfolio, but I must feel that it's fairly valued. So I'm kind of throwing my hands up in the air, and I'm focusing on maximizing that time value or maximizing that theta decay over this period of time. So if the stock continues to take off and it goes from 100 to 110 or something like that, I'm okay giving up those shares. I'm likely not going to close it out. If I can roll it still for a premium that makes sense, I might do that, but I'm not going to necessarily chase it. And if the stock declines, well, then I might feel that, okay, it's still a good stock for me to keep over the long term. I reduced my cost basis overall in the stock by collecting that option premium. and I might hang on to it and continue the same process. So a little bit of ambivalence on my part as far as my feeling on that stock, but I'm definitely not trying to desperately get rid of it. If I did, I would just sell it. So last example here is in the money, selling an in the money call on stock XYZ. In this case, we're going to do a $95 call and we're going to collect $600 for selling this option. It looks so glamorous because it's such a big number. And this is a bit tricky when first learning about options, but the most important thing in my opinion is to understand that option pricing is made up of two values. We have intrinsic value and extrinsic value. Those are the fancy names. Intrinsic value is real value that you can reach out and grab, right? So if I said, hey buddy, I have a stock worth $100 a share, I'll sell it to you for $95. How much real or intrinsic value does it have? You know it's worth $100 a share. So it has $5 of real value. So you would jump at the opportunity, turn around and make $5 real quick. That's intrinsic value. The other portion of the options value is extrinsic value. This is also often called time value. So this will exist always, but will be slowly depleting as we head towards that expiration date 45 days from now. And this is why you can't buy calls right now and immediately turn around and exercise them if they're in the money, because you're going to lose the extrinsic value every single time. Anyway, this is an option I like to use in the money, that is, with certain monthly paying ETFs and dividend stocks. So while it seems a little wild, it is actually the most conservative version and offers the largest hedge to our position. It is the closest to market neutral we can get with a covered call. However, it's also going to likely put your position in jeopardy if the stock rallies at all. So since you are already selling a deep in the money call, any upward movement of the stock will be greatly offset by the growing delta of the option. For that reason, I do this mainly with monthly paying REITs like O and LTC, or stocks like Dow Chemical, and LYB, that's Lino Basel, that offer high dividends like over 5%. I'll put a lot of time value into those options when I sell them deep in the money. Anyway, I know this one can be kind of confusing, especially when you're new to options. So if you have questions, shoot me an email or add a comment down below and I'll try to respond to you. But in this case, we're selling a $95 call with the stock all the way up to $100. Isn't that nuts, right? In this case, my example, we're collecting $600. So again, that would mean $500 of built-in real value because we're offering to sell it for $5 less than it's actually worth. That makes up $500 of that $600. The extra $100 is time value till it expires. So that gives us the first number to focus on here, which is 101. At 101, what happens at expiration? Well, if we do nothing, the stock would be sold or called away for $95 per share after expiration, but we would keep the $600 of option premium. It would be just like selling the stock for 101, 95 plus 6. If the stock went to 120, we would still sell the stock for 95 and keep the option premium, just like selling it for 101. Right? We capped ourselves at 101 on this trade. However, the hedge is more substantial with an in-the-money call. That is, if the stock fell to 95, which would be the ultimate goal again of this sold call, is to find that magical number, we would own the stock still and keep the $600 of option premium. We just made $100 and the stock declined 5%. What a country.
What a country. America, I love it.
Now the break even here would be 94, right? So if the stock fell all the way to 94, we would have a paper loss on the stock of $600. That would be wiped out by a realized gain of $600 on the option. Now, in the money calls can sound like magic at first until you get used to the math. Make sure you check your numbers, make sure it makes sense to what you are doing. I typically use trades like this, like I said, with O Income Realty. LTC Properties is one that I do it quite a bit with. So I will buy shares and I'll sell an in the money call where I know I can recapture how much in the money I'm selling it, plus some extrinsic value of the option. And if I can find that number to be attractive enough and sell out far enough and collect monthly dividends, and it makes sense, that's when I kind of pull the trigger on some of those. I also do it with some dividend stocks that pay a little bit higher dividends. So it's opportunistic a lot of times before I just jump into a trade. Another good habit when you start selling covered calls like this is to pay attention to your option delta. If you own 100 shares, that's a delta of 1. If you start selling calls against it, right, it's like giving up control of a certain number of shares. So if you sell a 10 delta call, you can kind of think of it as I'm giving up 10% of my share value right now. It's kind of a snapshot in time. I only want control of 90 shares. Whereas if you sell a very deep in the money call and it's a 90 delta, you're giving up 90% or 90 shares of your 100. So again, just a snapshot, but a good way to conceptualize where you sit right now and how market neutral your position truly is. So in the money, at the money, out of the money, what is your favorite approach to covered calls? Give me your favorite strategy. Let me know down below. Like and subscribe if you like this type of content. And any questions, hit me up. We'll talk to you real soon. Have a great night. Boop. By the way, I am branching out a little bit from YouTube, and I'm starting up my own website called MyWealthAdventure.com. It's about My Wealth Adventure and yours as well. So if you really like this content and you want even more, head on over there and sign up. It's free to sign up. It's just a newsletter and me gathering some data to find out exactly what my audience actually enjoys to hear and learn about. So head on over there and check out MyWealthAdventure.com. Thank you so much.